day by day, maybe every other day, I could potentially start dropping videos after videos after videos. So thank you guys for watching and keeping up. I will, if you guys have not already watched the last video that I posted, the 25th of September, which was yesterday, please do so. Like, comment, subscribe this video. In this video, I'm going to break down three different reasons why most traders are failing. So they're failing to become a consistently profitable trader and make a living off of trading. So I'm going to identify those things. Maybe, I mean, if you're, trading and you're at that point where um, you're like maybe borderline, like you're in and out of being profitable and, unprofitable. Maybe you just keep on getting at break even. I'm gonna break down why you're stagnant. Or you could be the person who's just pedaling backwards and you're like me when I first started. You're just running into the negative and instead of 6 feet under, you're 30 feet underground. Or like me, $50,000 underground when I first started. And obviously that was not in just a year, that was over the course of a couple years where I was negative. So I'm going to share with you guys my ideas of or reasons for why traders nowadays are unsuccessful and they're failing. Let me share my screen so that I can help you guys understand because I think I'm a visual learner, so I just assume most people are visual learners. And it's extremely helpful. So you guys should be able to see my screen. I'm gonna point out the first reason before I do. Like, comment, subscribe, and if you subscribe, you're most likely gonna get notified. Turn the notifications on so that you know exactly when I drop. First one is gonna be, and this is gonna be an advanced video, so just keep that in mind. So this is gonna be external to internal, right? Internal. So many of us are trading external instead of internal to external, internal to external. And this is something that you do not want. So you do not want to do external to internal. What you want to do is internal to external. Now, you will have a higher win rate if you focus your attention on internal to external trades. I'm going to explain this. So you can trade internal to external or external to internal, but your win rate could go lower because the probability of trading against the trend, the overall trend, is very it's not as high as trading with the trend, if that makes sense. So external to internal would mean that you're looking to trade against the overall trend. Internal to external would mean that you're trading with the overall trend. And that simplifies the difference between the two. Now, in order for us to comprehend this a little bit better, right? What I'll do for you is let's take a look at I just shifted from the 15. I'm gonna drag this here so that we might be able to look at the market as well so that you can have a better understanding of what this even means. All right. So this is a 15-minute time frame, right? If you see that the market is continuing to make highs, right? You see that this is a high, this is a low, and this is a high. There's traders, right, in the morning that might see price around here, 8:30. You see this 8:30 candle right here? They might say, I'm gonna do a pullback, right? I'm gonna pull back, stop loss above this high, and I'm gonna target, excuse me, I'm gonna target, excuse me, this wick right here because I see that there's imbalance, right? Or I might be targeting this imbalance. So it is obviously successful with this trade idea, but what if you want to hold your trade, right? What if you want to be a swing trader? Which long term makes more sense than just being a day trader, in my opinion. Um, because you can hold your trades for a longer period of time instead of capturing a small amount and going about your day. So instead of trading this way would be internal to external, right? Which is what you probably don't want to do as a trader if you want to be long-term successful and make a career out of trading. So if you're a person who is trading or looking for internal to external trades, you would figure out what the higher time frame is. And obviously, if we backtrack and rewind, let's take a look at the market on a higher time frame level. 4 hour time frame clearly indicates that we're bullish. The daily time frame also indicates that we're bullish. So if we're making higher highs and then again I scale back down to 15-minute time frame, you're for sure gonna see, that, maybe price might come to these levels here as in these imbalance levels right here. Um to, um hit one of these areas of interest or key levels to push price and continue going forward in as a uptrend. So around 8:30, which is it's a um it's a good time zone to trade because it's New York session. It's a kill zone is what you call it. So during a kill zone time, let's say you were to find maybe a reason to, sell, right? This 5 minute candle right here gives you a reason to sell. Stop loss right here, right? And maybe you want to target here, maybe you want to target the 15-minute imbalance. And what if you okay, see this is good thing this is an example. I don't trade like this, but I'm just showing you the way that external to internal people would be trading, which is I used to trade external to internal, but then I stopped. I recently stopped a couple weeks ago because I seen that my external to internal trades were not healthy for my win rate. And it wasn't healthy for my account's equity because I took the most losses trading against the trend, the overall trend, right? The 4 hour time frame, the daily time frame. Most importantly, the daily time frame, right? If you're trading against the daily time frame, then many times you're gonna find low winning trades. But yeah, if you're this guy who's trading external to internal, right, you could have found maybe a 1 to 5 on this, but then the people who are more in control, the buyers, they they take over, the sellers and they bring price up where instead of shorting the market or looking for sells, around you could have waited about an hour to scale down to smaller time frame and look for, a reason to buy in these imbalance levels, possibly 5 minute, possibly 2 minute to catch a trade and then once you caught your trade in the imbalance, stop loss below the low in the at the low, and then you can just continue to hold your trade. And then, you can move your stop loss. So instead of here, your stop loss would be moved here. And this is the hourly time frame. So, it's boom, you get the market to close out right here. So if you didn't feel comfortable holding your trade, right, you'd got at 1 to 7 maybe. If you felt like around 46, 920 to close out your trade, then that could have maybe been a 1 to 10. Or if you were to be someone like myself who is anticipating on holding trades until the market shifts, then that's also possible as well. Because the market can, if it wants to, continue going up because, there might be not enough sellers to short the market in the opposite direction, right? If the market is um doing a bull run and it just keeps on buying, then it might continue buying more. People might continue buying more, causing the price to inflate even more. And now, if the market is shorting and there's a lot of sellers in the market pushing price down, then the market can continue pricing down. Anything's possible, honestly, in the markets. Obviously, the market's not going to just move sideways. The market either has to be bullish or bearish. So it has to either be going up or down. Um, so yeah, there's that. That was question number, or not question, but that was, number two or number one. So number one is, you know, um, trading external to internal versus internal to external. My personal preference, again, is going to be internal to external because that allows me to trade with the trend. And a lot of times I'm able to hold my trade for a longer period of time instead of just closing at my take profit new high or new low, right? Or, targeting a high or targeting a low before creating a high, a newer high or a new low. So yeah, it allows you to stay in the market for a longer period of time if you choose to trade internal to external and instead of external to internal. Um, Secondly is going to be a strategy. So I think a couple of these things kind of intertwine with each other. So if you have a strategy, and this could be a strategy. Honestly, anything can be a strategy, right? Only looking for buys, only looking to buy markets is a strategy. Only looking to risk 1% is a strategy. Only trading on Tuesdays or and Thursdays and not trading on Sundays and Fridays is a strategy. Not trading on FOMC and NFP, CPI, those are strategies because it's like a formula that you're taking advantage of, and it's like um a mental framework. So you have a mental framework, and a part of your mental framework are these different strategies that you're using to be on the right side of probability. um so that's pretty much that pretty much is let me see if I can give you guys an example. So hmm, I'm not sure if you guys okay. For the people who box or spar, this might be something that you would, right? You might know. So let's take a look at this right here, right? And where was it? Okay. You can be in the middle, right? Three. You can be at one. You can be at two. So let me give you an example. This guy right here, right? This is called the slip, right? You're slipping to his outside if he punches with his right hand. This is someone who's orthodox. I'm not sure if you're southpaw, but if you're orthodox, this is how you know you're boxing typically. So let's say you're a boxer. This is A, this is B. If you're boxer A and you're throwing a two, right? He's throwing a two. He's going to probably want to slip. So he's slipping right now, and for him to avoid getting punched, he's bringing his head to the left side, to his left, but his right. So to avoid his punch. This is his strategy. So if he was to use this is internal, let's say this is internal to external, right? This is obviously the most profitable solution, right? Most successful solution is to trade internal to external. So fighter or boxer B slips left. Boxer A punches with his right hand, which is two, since he's also orthodox, but he misses because boxer B decides to slip left. And that's usually the side that you want to slip to. Because if he slipped to the right side, right, that would be trading NFP, maybe trading FOMC, maybe trading CPI, maybe trading external to internal against the trend, right? You're going against the trend, which that'll give him a higher probability of getting punched in the face if he were to slip right, right? If you slip right and your boxer B in this case, you might get hit. You might be low enough to right maneuver against the punch, but you have a better chance of not getting hit if you slip to the left to move away from its punch. So this is a good analogy that I'm gonna share with you guys because I just came from boxing like 2 hours ago, and that's the first thing that's on my mind that can correlate with this scenario of being on the right side of probability. Now, can you still um get wicked out? Can your stop loss still get hit? Can you still get punched in the face? Yes. Absolutely. You don't want to put anything past the market. And the reason why you don't want to put in anything past the market is because it's a random outcome. Random outcome meaning either upside or downside based on, your entry point. The market can go either two ways, up or down. Um, you just have to be on the right side of probability, right? And there can be all it takes is one person. And I've heard this from Mark Douglas. All it takes is one person across the other side of, you know, you might be on the East Coast, maybe the West Coast. It could just take one person to believe that the market should go in the opposite direction of your bias. Boom, right? You let's say you said, "Hey, I think buyers are in the markets now." I'm gonna give you a good example. Hopefully you guys take this as like take this serious because this is actually true. And sometimes you'll see that this happens. Right? So, hey, I get into the market here for whatever reason. I see that the market's going up, or maybe even here, right? And I say, I want to just let my TP ride. I'm not taking profits. I'm confident that this is going to continue going up. And you're in profit, right? You got a 1 to 2 risk to reward, maybe even a 1 to 3, 1 to 4 risk to reward. You're super confident. It's Friday. You're gonna close the week off in green or blue. Um, and you're having a good week. Then all it takes is somebody from West Bubble, right, to short the market, make it more realistic for you so you have a better idea of how this even looks, right? Like this is realistic stuff that happens. Because you want to make sure you have a good risk to reward. You're also taking partials at least when um it's the right time to take profits. Usually that's when the market creates a higher high, when you're trading with the trend or in a bullish environment. If it's taking profits when the market creates a lower low, or you're targeting a low, that would be, in a bearish environment where you would take profits. So yeah, like you can get situations where the market just spikes and takes you out, right? Hits your stop loss. And then, might even start pushing up to go into your direction. Like sometimes you get wicks like this. So you want to make sure you have proper risk management. You're also taking profits when you probably should take profits. And that's how you start to get on the right side of probability. Because let's say you didn't take profits at this candle right here. And you just left your stop loss here. You didn't do any type of trailing stop losses. Now your winning trade becomes a losing trade. So you don't want to be this person. I've been this person for a very long time, and obviously doesn't feel good. And it's a greedy mindset to have. Um, so I think that this is a great idea because you just don't know who's on the other side of the market. And by the time, like Mark Douglas said, by the time you even possibly figure out who the person was who shorted or, bought the market to make dent such a huge dent in the market, um, it's gonna be too late. And one, it's gonna be too late, and two, you can't do anything about it anyways. Like, what can you do, right? This is a huge market. Um, so yeah, that's that. So one I went over is going to be external to internal. Two is having a strategy, which kind of correlates with almost anything. Almost any idea that you have in the markets is a strategy. It's just up to you to take advantage of that strategy. And three is going to be improper risk management. So I think that people who have improper risk management, which I used to be a, a victim of risking my entire account, right? Full porting my account. Maybe I even just got paid and just threw money in the account and felt that if I risk, I'm looking at the risk to reward. And if I see that I can risk, $500, which could have been all of my account equity, and if the market goes in my direction, I could be up $20,000. Like these are real life situations that I put myself into, and clearly they haven't gone well. Otherwise, I would have already made a video on it, right? If that worked. And it's been about 6 years, and I've done it multiple times, and neither time worked because I probably just didn't have the risk tolerance to actually accept the $500 risk. I probably was like, in and out, right? In at one point, I see the market go in the opposite direction, might have seen negative $200, came out, went back in, full ported. You might be a trader that has experienced that. If you are, comment your experience. But I know personally that's been my experience for quite a couple times, and it's not a good feeling, especially once you just blew 500 in a day by situations that you could have avoided. And those situations that could have avoided could one of like the main way to avoid situations could also be just not trading at all and just sitting out of the market, and just that's something that I personally have done this week. This week I did profit off of gold and silver. Um but like for example when the market started to, trend downwards, I did take profits where I was at up here because I seen that the market started um caving downwards, right? Which was a not a I mean it could be a good or bad sign just depending on your idea that you have. Because some people, bought here. Excuse me. This is the first week that I've traded um both gold and silver at the same time. And I'm gonna share my experience with you. So Um, I'm gonna get back to improper risk management. But I just want to share this with you. So my experience with gold and silver has been that gold and silver gave similar entry points around earlier on in the week. I think it was during like Monday or Tuesday. Um, and then it ended up breaking structure. So gold ended up breaking structure, but like around here, um, but silver continued, right, going up. Silver's time frame continued, staying bullish on the 1 hour time frame for majority of the week. Literally, yeah, majority of the week. Since Monday, silver stayed bullish, but um when I seen that gold converted from, being from bullish to bearish from 1 hour time frame, I was like, I came out. And I did come out with profits, but to see silver and gold, I had to do research on it and see like what's the correlation. And it says that they do trend sometimes, but there's also other times where they'll trend in the completely opposite direction. So I would treat each metal or commodity differently than the other. I wouldn't treat them the exact same. Um, Also, I would obviously go for whichever one has the best risk to reward. So this is gonna, give you a an idea of risk management or not having improper risk management and adopting the mindset of proper risk management. So I'll give you two examples, right? One example being that let's say this is a 1 hour time frame. You want to, let's say you want to choose a trade, right? Boom. All right. Let's say that this is silver. I think gold is cleaner. Gold has cleaner price action. All right. All right, let's do this pullback right here. Let's say you want to trade this pullback right here. So if you wanted to trade with the trend here, let's say you're at, okay, so this is a 3 o'clock. This would be a 3 o'clock candle, and price right now is reversing, or not reversing, but it's pulling back. So if price starts pulling back, maybe you want to go down to the 15-minute time frame. Maybe you see that this is a reasonable low to target because you don't see any imbalances. So this can indicate that price might want to take out London session or Asian lows, right? If you want, you can do Asian range and kill zones. So, or honestly, this right here could help. Honestly, I might actually keep this because this is a good way to look at the markets because many times Asian lows or Asian highs gets taken out. Not always. So here, so right, Asian lows gets targeted. Once Asian lows gets targeted, that could be a reason to enter. If we scale back to the 1 hour time frame, this indicates that this was a 1 hour low, right? It's clearly a 1 hour low, and then this would clearly be a 1 hour high. So 1 hour high. Now this is the range, right? We're bullish on daily, we're bullish on 4 hour, we're bullish on daily 4 hour, 1 hour, obviously weekly too. Doesn't really make sense for me to go to those time frames, but I will just for you. Daily, right? You can clearly see that we're uptrend. 4 hour time frame clearly bullish, and 1 hour time frame again bullish. So now that we've identified 1 hour lows, right? 1 hour highs, Might want to go to maybe the 5 minute time frame. So 5 minute time frame, this indicates uh a candle that's clearly, taking out both of these candles, three of these candles to the left, which does indicate that we are for sure looking at a lot of buyers in the market. This candle, if it closes, I would personally enter. So it does close right there. If you were somebody waiting for, that candle to close, your stop loss would be right below, and then you can target here. So this candle's entry, or this candle's close would be your entry, and then that would be the trade right there. This is a 1 to 4. So you're risking before this goes anywhere. Let me just confirm. So this is you trading a $1,000 account, right? You're trading a $1,000 account. You have $1,000 in your account. Again, $1,000 is in your account. So this is your equity is $1,000. So you're gonna risk 1%. So if you're risking 1% of 1,000, that means you're risking $10. So now that means after you've, you know, entered, your stop loss is below this low, you're risking $10 for about, since this is a 1 to 4, for $40. So this could be a $46 profit, right? Because you can see this is a 4.6. So if you lose, you're out $10. If you win, you're up $46, about $46. Boom, TP hit. And price did come down to this, but it didn't pass the low. So this is just a good candle to trade off of. And as you can see, it dipped into it around 8:30 or 8:35, and then boom, right back. So you don't want to be the person that comes out of the market just because, price comes there. That just indicates that this candle or this area is an important area. So you should know these things. You should know what type of candles to look for. Again, this is an advanced video, so at this point you should know by now where important key levels are. And you can take partials here, right? Because if the market wanted to continue going up and you're out of the market, that can be frustrating. That can actually be frustrating. Um, if you took partials and you decided to just continue eating off this trade, right? That would have been fire. I'm gonna go back to this setup right here just so that I can explain the reason why you want to have proper risk management. So let's say let's say, right, it's like 3 o'clock right here. The next candle, it's like 3 o'clock. Boom, 3 o'clock. So you see that this is 3 o'clock. You missed this trade. Boom, market goes up. Let me go here. Market goes up. Boom, right here. Let's say you missed this trade and you want to enter here. Your stop loss would have to be all the way down here, and your take profit would have to at least be right here, at least minimum. So this is not even a 1 to 1. It's close to a 1 to 1, but it just wouldn't make sense for you to enter the market at this point. So this is how you can kind of time the market, and yeah, I think yeah, that's how you time the market. But some people say you can't time the market. Well, you should probably You should probably look at my entries. If you looked at my entries for the most part, you'll think otherwise. But yeah, this is an important level. You have to study how candles open, close, in order to find these areas of interest. Not only that, right, it was a 1 hour low. It was time sensitive. If you look here, you can also see that there were, so it's not just that, it's also other factors. You can see that there's like, or it was a respected, highly respected level. One, two, three, boom. You see the market start moving away from that area, comes back, so retraces, boom, back in the trend, back as a trend, boom, trending. So these are the reasons why traders are failing. They're trading against the trend. They're not using proper risk management. They don't have a profitable, they don't have a strategy at all. I'm not even gonna say profitable. They don't even have a strategy. A lot of times they're just using people's signals, taking other people's advice just because they feel like the market could go up. So they just copy other people's trade ideas. And if you don't actually understand what's going on a technical level, seeing where the buyers are, where the sellers are, what where are we at right now? Are we in an environment where there's more buyers? Are we in an environment where there's more sellers? Um, at this point, at this time right now, like even thinking how long could it possibly take? Should we be at this level, at this area of interest, at this zone by Friday? If we're not there by Friday, what could happen next week? This kind of just helps you mentally, I was gonna say mentally challenge your mind, but I take that back. This kind of, conditions your mind so that you have more patience. You're more patient with the market. You're more patient with yourself. You start to understand the types of questions that you should ask yourself so that you have enough ammunition for when price comes back, right? Because if you were somebody who entered the market on this candle at 4 o'clock and the market ran off on you because you fell asleep or your alarm didn't wake you up or your alert wasn't loud enough and your phone might have been on, the ringer could have been off. You could have said, "Hey, this is still a key level that I want to buy at." So boom, market comes down into that area. It could, give you an even better risk to reward, like a 1 to 10. Boom, my stop loss is still here. Boom. Instead of a $40 win, this would have been a $120 win or $120 or $25 win instead, just by timing the market. So that is important to know, right? It's important to know. I don't know, maybe that might be a good, right? When to time the market, I don't know. But when to allegedly time the market for legal purposes. So, yeah. So let me give you guys a quote. I think this can correlate a little bit about what I've already mentioned. For example, the spike that I had on the chart, the big, right, wick that I created to show you that somebody on the opposite side of the spectrum, right? Somebody 50,000 miles away, 100,000 miles away could have
had more of a belief that the market would go in a completely opposite direction, going against your idea, and boom, right? Market's out of your hands. So just keep that in mind. Okay, so here it is. This is an interview that Richard Dennis had. This is in the Market Wizard. So Richard Dennis was interviewed and he mentions you should expect the unexpected in this business, expect the extreme, don't think in terms of boundaries that limit what the market might do. If there is any lesson I have learned in the nearly 20 years that I've been in this business, it is that the unexpected and the impossible happen now and then. Now and then, meaning it could happen now, it might not happen now, it could happen later. You, you those are the only three alternatives or only three things that could definitely happen. Something won't that will not that will not happen is that an unexpected event may not happen later, right? Then because you don't know what's going to happen, and a lot of times if you study the markets on many different securities or markets, you're gonna see these random spikes that happen. I can, I'll bet $10,000. I can find a huge random spike on gold. Boom, 10,000. I need it right now. This is let me see. How big is this spike? 454. Like randomly. Who would have thought? Probably not many people. Boom, a spike right here. There's a spike right here. These spikes that just happen. This is a huge spike. This is a good size spike. These spikes that just happen. Spike. Spike. I think even silver has probably has bigger spikes than gold. This is a good size spike too. This is a good spike. These are wicks. These wicks could take a lot of people out, especially the people with no stop loss. This is a it's not as much as the 400, but it's still a good yeah. So yeah, that's pretty much the video. I hope you guys learned something. Comment what you learned from this video or took away from this video. Like, comment, subscribe. I hope you guys enjoyed this video. I'm probably also going to be posting a lot of shorts on my YouTube channel too, so keep a lookout for those. Thank you guys for watching. I hope you guys enjoyed this video again and enjoy your weekend.